all of them. I'm only going to tell you the ones that I think you really need to know. Now, the 5 types of financial ratios are price ratios, profitability, liquidity, debt, and efficiency ratios. We're going to start off with price ratios. So they are best used to compare the relative value of a stock and best for comparing stocks within the same sector. So basically, this is an apples to apples comparison. So you really wouldn't want to compare the price ratio of a stock that is in the consumer goods sector to a stock that is like Tesla or Apple or something along those lines, something that's like software or hardware. That's just really not an apples to apples comparison, and it would basically be worthless. Now, a few examples of price ratios are the PE ratio, which is price to earnings. There's the PEG ratio, there's the price to sales ratio, there's the price to book ratio. And like I said, I'm going to go over the ones that I think are the most important for you to know here in a minute. Profitability ratios are an indicator that a company is good at making profit. So basically exactly what it sounds like. A few examples of profitability ratios are return on assets, return on equity, and profit margin. Now notice I said an indicator here. Indicator means that it probably means that a company is good at making profit, but it doesn't mean that for sure. It's just a sign. However, if you look at a bunch of different ratios and they tell you good things, you know, it's one of those situations where if it looks like it, it smells like it sounds like it probably is it. Liquidity ratios are an indicator of a business's short-term health. And that basically means, can the business meet their short-term obligations? So a couple examples of this would be the current ratio and the quick ratio. Current ratio is current assets over current liabilities. Debt ratios, on the other hand, are an indicator of a company's long-term health. And there's a focus here on a company's finances and how efficiently a company uses its capital and debt. So a few examples of this would be the debt to equity ratio as well as the interest coverage ratio. And then the last one is going to be efficiency ratios. And this is a measure of how a company is using fixed assets such as real estate and equipment. So a few examples of this one would be the asset turnover ratio as well as the inventory turnover ratio. And now I'm going to go over what, in my opinion, are the 10 most important financial ratios that you definitely need to know. First of all, the PE ratio. This is probably the one that you hear about the most. And this means the price to earnings ratio. And this basically compares a company's share price to its earnings per share. So you can see the actual ratio on the bottom left. PE equals stock price divided by earnings per share. And a high PE ratio indicates that a company is very profitable. However, it could also indicate that a stock price is overvalued, right? Because you have the stock price on top and the earnings is on bottom. So it could be one or the other. On the flip side, a low PE ratio indicates that a company isn't very profitable, but it could also indicate that the stock is undervalued. So the number does tell you something, but it doesn't tell you everything. You have to use your knowledge, your wisdom, and your experience to tell whether, you know, a low PE ratio means that the company either isn't very profitable or it's undervalued. The price to book ratio is the amount that you have to pay to own $1 in equity. And you can see it, it's the price per share divided by the book value per share. Now, this is another one of those ratios that you only want to compare within the same sector or the same industry. And historically speaking, price to book ratio has been one of the best indicators of a company's value. However, especially with tech companies over the last 10 to 20 years, it has been flipped on its head. And the reason for this is because tech companies tend to have very high PB ratios because of intangible assets. So you really only want to use this as an indicator when you're comparing apples to apples, aka similar companies. Profit margin is a very simple ratio. It measures the sales that flow through a company's bottom line. And of course, shareholders love profit margin. That's what they want to see. They want to see the company making lots of money. And profit margin is basically the net income divided by the net sales. So they want to make the most amount of money with the least amount of cost. Definitely a very good short-term indicator of a company's profitability. But with that being said, cutting costs is not always a great thing. Sometimes you cut costs too much and that hurts a company long-term. Current ratio is a company's ability to pay its short-term liability using its short-term assets. So greater than 1 means a company has more short-term assets than it does liabilities, and that tends to be a good thing. Less than 1 means a company has more short-term liabilities than assets. Now, this is another one where when it comes to certain types of companies, this one is just totally turned on its head. And the reason for that is because many tech companies, because they have such high upside, will actually go deep in debt for sometimes up to a decade. And people will still remain invested in them because of the fact that they know that company is taking a significant amount of the market share. And once they secure that amount of the market share and they've established themselves, they're going to start making money hand over fist. At least theoretically, that's what they think. Quick ratio is very similar to current ratio. The only difference is it doesn't include the inventory. And inventory is definitely less liquid than cash. So there are some companies that might take them a long time to sell their inventory, whereas there's other companies where things are flying off of the shelves. So depending on the type of company you are evaluating, a current ratio might be better than a quick ratio or vice versa. Next, we're going to talk about asset turnover ratio. And this is basically an indicator that shows how effective management is at running the company. And this basically divides the revenue or sales of a company by the average total assets. So asset turnover ratio is revenue divided by assets. Now this is important because sometimes the profit margin really really isn't the only thing you should look at. Just because certain products have a high profit margin, if they don't turn over very fast, then they're just going to sit there for a long period of time. And so this is basically a way of making sure that products aren't, sitting on the shelves collecting dust for too long before they get turned over. And it also shows how well the company is being managed. Another very similar one is the inventory turnover ratio. It's an indicator of how quickly a company is able to sell its inventory. And the inventory turnover ratio is the cost of goods sold divided by the average inventory. Now, this is one of those things where sometimes profit margin doesn't matter as much as volume. So if a company has a product that has a really high profit margin, but it just sits on the shelf for a long time, that isn't necessarily going to be as profitable as a product that has a low profit margin, but it has high turnover, so it gets sold really quickly. Now, more turnover is a good thing because it shows the company isn't wasting money storing stuff. Now, the debt to equity ratio compares the borrowed capital to capital contributed by the shareholders. Now, a higher ratio tends to be a bad thing because that means a company is likely not able to meet its debt obligations. That means a company is borrowing a lot of money compared to how much it's worth. Return on assets is an indicator of how efficiently a company is using its assets to achieve profitability. So a really good example of this one that would improve your return on assets score is, for some companies, it's better for you to actually just buy a building rather than leasing or renting a building. But for some companies, it's the other way around. It's better for you to lease or rent the building rather than buying it. So an example of this is, let's say you live in an area that you personally believe the property prices are going to be going up a lot soon. Something